And welcome into Making Sense. You know, that's all you've got to do is look around and we find out that we are in the midst of a pandemic. It's a pandemic that's a health issue, but more and more as things seem to be kind of stabilizing, and I don't think they're really stabilizing as much as we think they are, but there's looking into the financial markets and say, what are we going to be able to do to get this economy back going? Of course, Uncle Sam usually wants to jump in and do some things. They have done some things. You know, those are they're my age. You got to realize that, yes, you got some money, but somebody's got to pay for it. Brandt McDonald's here, McDonald Hagen Wealth Management. And Brandt,
Yeah.
the government's kind of stepped up in big ways here.
They have.
Ways that you and I have never seen.
No, it's unprecedented.
And they even want to do more.
They want to do a lot more.
Right.
So, you know, we've talked in a prior show about the idea that, you know, through fiscal and monetary policy, we would be able to sort of grease the tracks, so to speak, to provide necessary liquidity in the markets. When I talk with clients and customers around the South, this is a very complex subject, but I want to try to boil it down this way. During the financial crisis, we did $4.5 trillion in QE, quantitative easing, which is essentially money out of thin air. With a $20 trillion economy, at that time, it was roughly 25% of the size of the economy. And we saw the impact that it had on all asset prices.
Yes.
Stocks, real estate, hard assets, real assets. Think about anything, when I say real assets, things that if you hold them and you drop them on your foot, it's going to hurt.
Yep, yep.
So that's what happens when you print money. When the supply of money goes up, everything has to be repriced as a result. In this situation, we see a little over $6 trillion. I think we're well on our way to $10 trillion, no question in my mind, which is approaching 50% the size of our economy. You know, essentially the government is borrowing several years worth of GDP in the future.
Growth, right.
And I truly believe that there are going to be derivative effects from this that are going to be mind-blowing. And I think that we all have to kind of rethink how we approach investing in a world like this. You know, I give you an example. Over in Europe and around the world, they're using negative interest rates as a way to stimulate their economies. We've seen, by and large, that does not work. What it's doing is it's forcing cash. They're penalizing cash, and they're forcing institutions, banks, and individuals to go and commit that cash to risk-based types of investments. It creates sort of a non-natural capital flow, if you will. Typically, in free market systems, you would see cash be in cash if it needed to be. But if policymakers go out and penalize a cash holding, they force you to move it. For example, right now, in terms of real terms, a cash holding is really a decaying asset. It's decaying at probably close to 2% per year. So for people who are sitting there holding cash, they're going to have to do something with it. So I think you're going to see that will find its way into some of the high quality equity names out there, the ones that still have a healthy dividend. You'll probably also find it going into real assets, a lot of the metals, mining, things like this, so that as inflation begins to come back, which it will, those are the first places that you look to see where you're going to find positive performance or outperformance in terms of the broad market. I think passive investing using indexes at least over the next 3 to 5 years is not a great strategy. This is going to become a market where it's we used to say in the old days, it's a stock picker's market. I don't know that it's really a stock picker's market, but it's certainly going to be a sector picker's market. Really understanding where the money is going to flow and how to protect your investments, how to protect it in terms of real purchasing power in an environment where they're printing money like crazy. And so that's again another way that you have to manage risk in retirement. That's what we've been doing, and I can tell you right now, we have in-house our portfolio models, which are proprietary models that our research team builds. And we do have some cash, but we're slowly committing that cash over the course of this year as situations develop. and it's quite different. The allocation is quite different than it was in 2019, 18, 17. The construct is different because it's built for this new world that we're going to have to deal with all of this new money that's been created, and probably new taxes in 2 to 3 years to pay for it.
I'm going to get you to come back next week. We want to talk about retirement because a lot of our viewers are getting up to that age. So just remember this, be careful what you're doing in your investments because these are very troubling and trying times. And we'll be right back right after this.